Good morning, welcome to CATEX TV. My name is Frank Fortunato. Today is Wednesday, May 29th, 2013. Big news in the reinsurance world. Down at Endurance Re in Bermuda, John Charman has returned. The current CEO of Endurance Re, David Cash, who is a Bermudian, was unceremoniously dumped despite having been with the company since 2001. He had been the chief executive officer, no longer. Mr. Charman has come in. He is the chief executive officer, and he is also the chairman of the company. It seems that this was a little bit preordained because Mr. Charman and members of his family had become one of Endurance's biggest shareholders with the purchase of about $30 million worth of the company's stock. Charman, who is 60 years old, has been in the industry for about 4 decades, and he was the founder of Axis Capital Holdings Limited. Of course, Mr. Charman's appointment means a couple of things. Charman has been on the landscape now for the past 6 months talking about the fast money coming into the reinsurance sector and warning that it's necessary to maintain and maybe return to very strict underwriting standards, and that reinsurers in particular should not be insuring business in which they're not getting the desired premium for. He says that there is a bubble coming, and when it comes, when it pops, the ILS groups are going to be out, and those companies that were traditional reinsurers that banked on ILSs are also going to be sunk, and it's going to be left to traditional companies to pick up the pieces. It seems as if Endurance's board has determined which way Endurance is going to go. This could be a big signal for the balance of the industry as a whole. Meanwhile, in another signal that's going on, the big three broker Willis, which is number 3, has placed itself squarely on a collision course with Tom Bolt at Lloyd's. Willis made a proposal last week to put together a 20% facility of its London market specialty book. This followed hot on the heels of Aon's Berkshire deal, in which Berkshire agreed to take a 7.5% quota share of a book of business that Aon places into the Lloyd's market. Following that, and perhaps following some whispers of what Willis was going to do with their Global 360 initiative, Tom Bolt at Lloyd's issued a very strong warning last week indicating that future deals of the Aon Berkshire type would be held to a much, much stricter standard. Now, what's happened now is some pushback has begun to come in the Lloyd's market. Stephen Catlin, who was the founder of Catlin Syndicates, who is probably one of the single most influential men in the London market, said he cannot think of a single instance where a reinsurer has given its pen to a broker with no restrictions and the facility has performed well over time. Of course, this is exactly what Berkshire has done with Aon and exactly what markets will do with Willis. He commented on the wake of the Berkshire-Aon deal, said, "I can't think of any broker facility lacking underwriter controls that has ever stood the test of time. What's different here?" He said there was a danger of giving away a blank check. He makes it very difficult to calculate the downside of capital. Name any situation, he said, where an underwriter has given away his pen without restrictions and won. There have been some other unattributed comments. Mr. Catlin's not afraid of being attributed. One Lloyd CEO dismissed the Willis deal as saying it's about the commission, not the clients. If there was no enhanced commission, I doubt very much whether they would be doing this. Another underwriter at a Lloyd's syndicate said this is because even the biggest brokers can't make enough profit now with their business model, so they're out there looking for extra revenue. This story is going to go on and on, you'll see. Meanwhile, the Lloyd's syndicate Cathedral Capital released an investor memorandum to interested parties the other day that called for first-round bids by a date in the middle of June. Cathedral has been prompted to put itself up for sale because it's about 55 or 60% owned by UK private equity firm Alchemy. Apparently what's happened now, about 50% of Cathedral's book is property treaty business, with around 3/4 of that being in the United States. Now the bottom is falling out of the U.S. property cat market right now. Rates are off by about 15+%. And there's some speculation that Cathedral might in fact suffer a sizable knock to its income because of this. Now, the difficulty associated with the size of its U.S. cat exposure is amplified by the negative that will present to a possible acquirer that will be coming from the U.S., for example, a U.S. property and casualty insurer. No one would be interested in doubling down on U.S. cat exposure. Private equity businesses are meanwhile unlikely to be willing to break the £200 million mark, £200 million sale price mark for Cathedral, which would require them to bid in excess of about 1.3 times book value. Could be a little bit of a difficult time for Cathedral to come out to sell itself, but this we'll see what happens. Alchemy might have a second thought when they begin to see some of the offers that come in. This would be a much better deal if premiums were going through the roof, but they're not. Cooper Gay made some news today. Ron Carlier, the former chief executive of R.K. Carville, has been appointed as chief executive of Cooper Gay Re. He's going to be based in New York. He's going to be reporting to the chief executive of Cooper Gay, Sweat & Crawford, North America, who is Sean Hooper. Mr. Carlier left the insurance sector a few years back. He's been working on a number of forestry projects, of all things, most recently serving as chairman of the Sustainable Forestry Organization up in British Columbia called Forest First Columbia. There was a big train explosion in Baltimore County, not too far from Baltimore City yesterday afternoon. Miraculously, no one was hurt. A train at about 2:15 p.m. Encountered a garbage truck on a unguarded crossing in Rosedale, Maryland. A huge explosion occurred. For some reason, it was captured on various iPhones, played repeatedly on cable TV stations here. The explosion rattled houses about half a mile away. Several buildings at the area near the site of the collision actually were flattened, but miraculously, no one was injured. South Korea indicates that it has suspended operations in 2 nuclear power plants and extended a shutdown of a third to replace parts that were supplied using fake certificates. The government warned this morning that there would be unprecedented electricity shortages and rolling blackouts this summer due to the nuclear shutdowns. Apparently, falsified safety certificates mean that as a result of the government looking at the falsification of the documents, they've shut down 10 of the country's 23 nuclear plants. The government said that power shortages are on an unprecedented scale are feared this summer. Blackout alerts triggered automatically when reserves dip below a certain level were highly likely. It said it would strongly enforce measures to reduce energy consumption. Shortages in August could be very serious. If you have business interruption coverage in South Korea, you might want to be looking at that policy right now, because it seems as if some of the big industrial concerns are going to be suffering problems. That's the news for today. Welcome back, John Charman. And if we have any breaking news, we'll come back and tell you. If not,